There's a 73-year-old couple in Florida sitting on $1.2 million in their 401ks. They did everything right. Maxed out contributions for 30 years. Never touched it. Let it compound. And now the IRS is about to force them to withdraw over $45,000 a year, whether they need it or not. That withdrawal pushes them into a higher tax bracket, triggers a 15% Medicare surcharge, and costs them an extra $12,000 in taxes they could have avoided. Meanwhile, there's another couple, same age, same balance, who made one tax move back when they were 65. They convert a chunk of their IRA to a Roth every year for 8 years, pay tax on their own schedule, control their brackets. And now at 73, they're withdrawing whatever they want, tax-free, with zero Medicare penalties. The difference between these two couples isn't luck. It's not market timing. It's understanding one brutally simple fact about retirement accounts that most people figure out way too late. Your IRA isn't your money. It's a joint account with the federal government, and they get to decide when you take distributions. So here's what I'm going to show you. How to systematically bleed your IRA before the government forces your hand. Why waiting until 73 is financial malpractice. And how to use something called bracket management to create predictable, tax-controlled income for the rest of your life. This isn't about avoiding taxes. That's impossible. This is about controlling when and how much you pay, which turns out to be the entire game. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report, so I don't store any of your financial data. Link in the description. Think of your traditional IRA like a pressure cooker. Every year it grows, the pressure builds. Tax-deferred growth sounds amazing until you realize what deferred actually means. It means the tax bill is growing right alongside your balance. And at age 73, the IRS opens that valve whether you're ready or not. That's when required minimum distributions kick in. At 73, you're forced to withdraw roughly 4% of the balance. By 80, it's 5%. By 90, it's over 8%. And those withdrawals stack on top of Social Security, any pension income, investment income, from taxable accounts. Suddenly, you're in a tax bracket you haven't seen since you were working full-time, except now you can't reduce it by contributing more to your 401k. Here's the thing most people miss. The Secure Act of 2019 moved the RMD age from 70.5 to 72. Then the Secure 2.0 Act in 2022 bumped it again to 73. And in 2033, it goes to 75. Politicians love to talk about giving you more time to let your money grow. But what they're really doing is letting that tax bomb get bigger. Because the longer you defer, the larger the balance, the larger the forced distribution, and the more tax you pay. It's brilliant from the government's perspective. Let your money compound for an extra 2 years so they can take a bigger cut later. Now, you might be thinking, but Tom, isn't tax-deferred growth always better? If I'm paying tax later, that money can compound in the meantime. And look, on paper, in a spreadsheet where your tax rate stays constant forever and you never hit Medicare surcharges and your state doesn't change its tax code, sure, maybe. But we don't live in spreadsheets. We live in a tax system with brackets and cliffs and phase-outs and penalties that all interact in ways that punish big one-time distributions. And here's the really fun part. Most people retire into a lower tax bracket for maybe 5 years. Then Social Security kicks in at full retirement age. Then RMDs hit. Then suddenly, they're back in the 24% federal bracket. Except they have way less control over their income than they did when they were working. Let me tell you about a couple I know. Not clients, just people I met at a conference. Both were engineers. Retired at 64. Combined income from Social Security was about $50,000 a year. They had $1.4 million in traditional IRAs and about $80,000 in a taxable brokerage account. They figured they'd wait until 73 to start RMDs because that's what their buddy at the country club told them to do. Fast forward to age 73. Their first RMD was just over $50,000. That pushed their total income to $100,000. They went from the 12% federal bracket to the 22% bracket. But here's where it gets really interesting. That extra income also pushed them over the threshold for IRMAA, which is the income-related monthly adjustment amount for Medicare. Basically, if your modified adjusted gross income exceeds certain levels, you pay more for Medicare Part B and Part D. For 2026, if you're married filing jointly and your income is above $214,000, you start paying surcharges, but there are lower tiers that kick in earlier. This couple hit the first tier. Their Medicare premium went from $175 per month to $245 per month per person. That's an extra $1,600 a year in Medicare costs alone, on top of the higher tax bracket. They didn't need that RMD money. They were spending maybe $70,000 a year, well covered by Social Security and their taxable account. But the IRS doesn't care what you need. They care about what you owe. Now here's what they could have done instead. Let's rewind to age 65. At that point, their income was just Social Security. $50,000 a year. In 2026 dollars, that puts them solidly in the 12% federal bracket, which goes up to $94,300 for married filing jointly. That means they had about $44,000 of room to fill before hitting the 22% bracket. So here's the move. Convert $44,000 from their traditional IRA to a Roth IRA. Pay 12% federal tax on that conversion, which is about $5,300. Maybe another $2,000 in state tax, depending where they live. But now that $44,000 is in a Roth, growing tax-free forever. No RMDs, no future tax, no Medicare surcharges later. And they still have plenty of liquidity from their taxable account to cover living expenses. Do that every year for 8 years. By the time they're 73, they've converted $350,000, paid about $60,000 in total tax at the 12% rate, and reduced their IRA balance from $1.4 million to $1.05 million. Now, when RMDs kick in, the distribution is only about $40,000 instead of $56,000. That keeps their total income under the IRMAA threshold, keeps them in the 12% bracket for longer. And they've got $350,000 in a Roth that they can pull from anytime, tax-free, without affecting their income calculations at all. The math is absurd. By paying $60,000 in tax early, they save over $200,000 in tax and Medicare surcharges over the next 20 years. And they have way more control. By the way, hit subscribe if you like this content. Otherwise, YouTube's algorithm may never show you my videos again. Now let me show you exactly how to do this without screwing it up, because there are about 6 ways to get this wrong. First, you need to understand bracket management. The goal isn't to convert as much as possible. It's to convert as much as you can while staying inside your target tax bracket. Most people should be aiming to fill up the 12% bracket, which for 2026 is up to $94,300 for married filing jointly. Some people, depending on their situation, might want to go into the 22% bracket, which extends to $201,050. But I've never met someone who should intentionally convert into the 24% bracket or higher. At that point, you're paying too much in current tax for future benefit. Here's how you calculate it. Step 1, add up all your expected income for the year. Social Security, any pension, part-time work, dividends, interest, capital gains. Step 2, find the top of your target bracket. Let's say 12%, so $94,300. Step 3, subtract your expected income from that bracket ceiling. That's your conversion room. Step 4, convert that amount from your traditional IRA to your Roth IRA. That's it. You're filling up the glass without letting it overflow. But here's where people mess up. They forget about the gross up on Social Security. Depending on your income, up to 85% of your Social Security benefits can become taxable. So if you're converting a bunch of IRA money, you're not just paying tax on the conversion, you're also making more of your Social Security taxable, which effectively increases your marginal rate. This is why you need to model this stuff properly, not just guess. When I run these scenarios for people with multiple hundreds of thousands of dollars on the line, I don't use some free online calculator. I build out pro forma tax returns line by line to see exactly how each type of income interacts. Because dividend income gets treated differently than capital gains, which get treated differently than IRA distributions, which all affect Social Security taxation differently, it's a multivariable optimization problem disguised as simple arithmetic. Let's talk timing. The best time to do Roth conversions is at the end of the year, like November or December. Why? Because by then, you actually know what your income was. You know how much you made from dividends. You know if you sold any investments for gains. You know if you did any consulting work. You're not guessing. You can calculate your exact conversion room and fill it precisely. If you convert too early and your income ends up higher than expected, you might accidentally push yourself into the next bracket. If you convert too little, you're leaving room on the table. Do it in December and you have perfect information. Another mistake people make is thinking about this as a one-time move. It's not. This is an 8 to 10 year strategy. You're systematically transferring money from a tax-deferred account to a tax-free account, ideally during the window between retirement and RMDs when your income is at its lowest. If you retire at 60 and RMDs start at 73, that's 13 years. You can move a lot of money in 13 years if you're disciplined about it. I know a guy who retired at 58 with $2 million in his 401k. He's been converting $120,000 a year, right up to the top of the 22% bracket. He'll have moved $1.8 million into a Roth by the time he's 73. His RMD will be a rounding error. That's control. Now here's where this gets really interesting. Let's say you do these conversions. You're paying the tax from your taxable account because you don't want to reduce the amount going into the Roth. And suddenly you've got a $300,000 Roth IRA sitting there. What do you do with it? Most people think of their Roth as this sacred emergency fund that they'll never touch. But that's actually the wrong frame. The Roth is your tax-free growth engine. If you need money before 73, you should be pulling from your Roth, not your traditional IRA. Why? Because every dollar you leave in the traditional IRA is another dollar that's going to get hit with an RMD later. But every dollar you pull from the Roth is one less dollar subject to future tax and Medicare calculations. You're not saving the Roth for later. You're using it now to create optionality later. Here's a scenario. You're 68, you want to buy a new car, $35,000. You could pull it from your traditional IRA, which would add $35,000 to your taxable income that year, or you could pull it from your Roth, which adds $0 to your taxable income. Same car, wildly different tax outcome. And if pulling from the IRA pushes you into a higher bracket or triggers IRMAA, you're not just paying tax on $35,000. You're paying a higher rate and a Medicare surcharge. The real cost could be $50,000 or more. The Roth is your tax-free spending account. Use it. But now you might be thinking, wait, if I'm converting all this money and paying the tax, where's that tax money coming from? And this is the critical piece. You should be paying the tax from your taxable brokerage account, not from the IRA itself. If you convert $40,000 and withhold $5,000 for taxes, you're only moving $35,000 into the Roth. You just paid tax on $40,000 but only got $35,000 working for you. It's inefficient. Instead, convert the full $40,000 and pay the $5,000 in tax from your checking account or brokerage. Now the full $40,000 is in the Roth, compounding tax-free. Over 20 years, that difference is enormous. Let me give you a concrete example with real numbers. Let's say you're 65. You've got $1 million in a traditional IRA and $200,000 in a taxable account. You're planning to convert $40,000 a year for 8 years. Scenario 1, you withhold tax from the conversion. You convert $40,000, withhold $5,000 for tax, net $35,000 into the Roth. After 8 years, you've moved $280,000 into the Roth and paid $40,000 in tax from the IRA itself. Your traditional IRA is now down to $680,000. Scenario 2, you convert the full $40,000 and pay the $5,000 in tax from your taxable account. After 8 years, you've moved $320,000 into the Roth, paid $40,000 in tax from your brokerage. Your traditional IRA is down to $640,000. That's an extra $40,000 in the Roth, which at a 7% growth rate turns into an extra $77,000 by the time you're 85. Same tax paid. Massively different outcome. This is why I say most financial mistakes aren't math problems. They're brain problems. People don't think through the second order effects. Now let's talk about the psychology of this. Because the hardest part of this strategy isn't the math. It's convincing yourself to write a check to the IRS before you have to. Every instinct you have is telling you to defer. Defer the tax. Keep the money growing. Don't give the government $1 before they force you. But that instinct is wrong. You're optimizing for the wrong variable. You're optimizing for maximum deferral when you should be optimizing for maximum control. Deferral is a tool. It's not the goal. The goal is to have predictable, tax-efficient income in retirement. And sometimes that means paying tax early to buy yourself options later. Here's another story. There's a dentist I know who sold his practice at 62, walked away with $4 million in his 401k. He could have started converting immediately, filled up the 22% bracket every year. By 73, he could have moved over $2 million into a Roth and still had a manageable RMD, but he didn't want to pay the tax. He kept saying, I'll do it next year, next year, next year. Now he's 71, still hasn't converted $1, and he's about to get crushed. His first RMD is going to be over $150,000. That's going to push him into the 32% federal bracket. He's going to hit the highest IRMAA tier, which adds another $500 per month per person to his Medicare premiums. And because he lives in California, he's paying 13.3% state tax on top of that. He's going to pay over 40% total tax on money he doesn't even need. And there's no way out now. The train has left the station. All because he couldn't get over the psychological hurdle of paying tax voluntarily. Compare that to someone who thinks about this correctly. They realize that paying 12% tax now to avoid 22% or more later is just good math. They realize that controlling their income means controlling their Medicare costs. They realize that having a big Roth balance gives them flexibility to handle lumpy expenses without creating tax spikes. They're playing a different game. They're not trying to minimize this year's tax. They're trying to minimize lifetime tax. And those are completely different objectives. Here's the other thing nobody talks about. Once you're past 73 and you're taking RMDs, you lose the ability to control your income. You can't just decide to have a low income year. The RMD is coming whether you like it or not. But if you've done conversions earlier and built up a Roth balance, you have options. Maybe you want to do a big Roth conversion in your 60s, but then you want to buy a rental property in your 70s. If all your money is in a traditional IRA, pulling out a down payment could wreck your tax situation. But if you've got a Roth, you can pull the cash tax-free and your AGI doesn't move. That optionality is worth something. It's hard to quantify, but it's real. Now let's talk about the Medicare piece because this is where things get really expensive really fast. IRMAA is one of the most vicious stealth taxes in the system. It's based on your modified adjusted gross income from 2 years ago. So if you have a big income spike in 2026, you're going to pay higher Medicare premiums in 2028. And it's not a smooth increase. It's a cliff. If you're married and your income goes from $213,000 to $214,000, your Medicare premium can jump by over $1,000 a year per person. That's a marginal tax rate of over 100,000% on that one extra dollar of income. It's insane. And most people don't even realize they've triggered it until they get a letter from Social Security telling them their premium is going up. Here's the brackets for 2026. If you're married filing jointly, the first IRMAA tier kicks in at $214,000. The next tier is at $267,000, then $320,000, then $428,000. Then above $750,000, you're paying the maximum. And these aren't indexed to inflation properly. So every year, more people get caught in them. It's a classic case of bracket creep. If you're doing RMDs and you're not paying attention, you can easily blow through 2 or 3 of these tiers without realizing it. But if you've done conversions early, you can engineer your RMD to keep you below the first tier. Let's say you're 75 and your RMD is $50,000. You've got Social Security of $40,000, pension of $30,000. You're at $120,000, well below $214,000. You're paying the base Medicare premium. But if you hadn't done conversions and your RMD was $90,000 instead, now you're at $160,000 total. Still below the first tier, but getting close. One more large distribution, maybe you sell some stock and you're over. Now you're paying an extra $2,000 a year in Medicare costs that you can never get back. This is why I say retirement planning is really just tax planning with a longer time horizon. Let me give you one more scenario to make this concrete. Two couples, both have $1.5 million in retirement accounts at age 65. Couple A does nothing, lets it grow. Takes RMDs at 73. Couple B converts $60,000 a year from age 65 to 72. 8 conversions, $480,000 move to Roth. They pay about $70,000 in total tax on those conversions, all at the 12 or 22% rates. By age 73, Couple A has grown their IRA to $2.1 million. Their first RMD is about $80,000. Added to Social Security and other income, they're at $140,000. They're in the 22% bracket, and they'll stay there for the rest of their lives. Over the next 20 years, they'll pay about $600,000 in taxes on their RMDs. Couple B has $1.2 million in their traditional IRA and $650,000 in their Roth by age 73. Their RMD is about $45,000. Total income is $105,000. They stay in the 12% bracket for another decade. Over the next 20 years, they pay about $250,000 in taxes on their smaller RMDs. But they've got the Roth to pull from tax-free anytime they need it. Net result, Couple B paid $70,000 early to save $350,000 later. Plus, they avoided IRMAA surcharges. Plus, they have more spending flexibility. It's not even close. So here's the part where I'm supposed to tell you the 3 things you need to do right now. First, if you're between 60 and 72 and you have a traditional IRA or 401k, run the numbers on Roth conversions. Calculate your AGI. Find your bracket ceiling. Convert up to that limit every year. Second, pay the tax from outside the IRA so the full conversion amount grows tax-free. Don't withhold from the conversion itself. Third, model this properly. Don't guess. Don't use some random online calculator that doesn't account for Social Security taxation or IRMAA. Either learn how to build a tax projection yourself or pay someone who actually knows what they're doing. Because screwing this up costs you 6 figures. And here's the cynical closer. The financial services industry doesn't want you to do this. Your advisor is probably not bringing it up. Why? Because conversions create tax drag in the short term, which makes their performance reports look worse. It's easier to just let your IRA grow and collect their fee on a bigger balance. They're optimizing for their revenue, not your after-tax wealth. Lazy investing built more fortune than crypto memes, but you have to actually know what you're doing first. Otherwise, you're just another dentist sitting on a $4 million tax bomb wondering why nobody told you about this 15 years ago.